Alright, hey everyone, welcome to today's video. So basically today I'll be going over the basics of supply and demand, and I'll be covering what smart money trading has to do with supply and demand. So today we'll be going over the basics, and I'll be showing you how to mark up some key zones and what you should be identifying for those zones. So first I want to start with some keywords to understand. So smart money, it's the big financial institutions, as in JP Morgan, Goldman Sachs, etc. Now, inefficiency, there is some sort of imbalance in the market that needs to be filled. I'll go on to that a bit later. Now, engulfing is when a candle gets fully covered by the next candle. And an order block is just a supply and demand zone. And SMC stands for smart money concept. Okay, so what is supply and demand? In Forex trading, supply and demand refers to the behavior of traders in the market and how that affects the exchange rate of different currencies. The demand for a currency is determined by the number of traders that want to buy that currency, while the supply is determined by the number of traders that want to sell that currency. So when demand for a currency is high and supply is low, the value of that currency will increase. Conversely, when the demand is low and the supply is high, the value of that currency will decrease. Traders use this knowledge of supply and demand to make predictions about the future value of the currencies and make trades accordingly. So why I said predictions is because trading is basically just a probabilities game, so everything can be 50-50, but with your edge in the market, that's proven to work. You'll have your edge in the market, which will create a higher probability. Okay, so now this is the introduction into smart money trading. So welcome to smart money trading, a style of trading where we incorporate institutional concepts within our trades that allows us to have the opportunity to trade with the market makers that will give us that edge in the markets. We will guide you through SMT and help you understand and identify a specific market behavior that will allow us to trade and invest in harmony with the market manipulation caused by the smart money. Okay, so we already know that the big institutions are the market movers. They trade with such volume that it doesn't even compare to 0.0001% of the amount of volume us retail traders trade. So then what is smart money exactly? The concept of smart money refers to large institutional investors and professional traders who are considered to have a high level of market knowledge and access to better information and resources. These traders and investors are often thought to be able to move the markets in their favor by using their knowledge and resources to take positions before retail traders. Okay, so on this chart here, as you can see, I've labeled where the smart money is. So these big up candles here are from those institutional traders that have created such volume that it's printed these massive candles that have left behind imbalance in the market where it's inefficient price action. So later on, price must come back to these areas to fill these candles. So as you can see, it's pretty clear where the institutions have stepped in, because all these little candles here, they're just made up of all us retail traders basically trading based on what we know. And this is those institutions stepping in, taking out these sellers here basically and drive the market up in their direction. So now we'll go over identifying and drawing some zones. One of the most important concepts about this strategy is the understanding of drawing the right zones. A zone on the chart is an area where you can clearly identify a large order being placed in the market. You notice the order being placed, then a rapid move happens away from the area, creating imbalance and possibly breaking structure. The candle before the big rapid move will be what we use to mark up our zone from. So what I look for when identifying and drawing zones are a consolidation period, because the buyers and sellers are essentially fighting each other and creating liquidity on both sides. So liquidity is the next one. So those sort of tie in with one another. So the consolidation period is obviously built up on that liquidity. Once that you get that big impulsive candle, it will take out one side of the market, which will then create the liquidity. Or other forms of liquidity are like equal lows, equal highs, or trendline liquidity. So I'll look for indecision, so those doji candles to mark up zones from. And then high volume, so a strong move away from that zone. The next is imbalance, so that zone creates imbalance and looks attractive to buy or sell from. Also premium areas to sell from and discounted areas to buy from. So now I'll cover premium and discounted zone identification. When identifying multiple zones, you want to go with that zone that is in the discounted or premium levels. Equilibrium is the midpoint of a price range or the midpoint of a swing. It's a level where the price is neither cheap nor expensive. This isn't a point where you want to execute a trade-off, where you want to be buying at a point that is below the equilibrium or selling at a point that is higher than the equilibrium. The methodology of this idea is to get the best risk to reward and highest probability trade. Now to find these levels, I simply use the fib tool and mark from the swing points. For premium supply, I'll mark from the swing high to the swing low. For a discounted demand, I'll mark from the swing low to the swing high. Now, once we have identified our consolidation, we draw our entry zone off the indecision candle. An indecision candle is when buyers and sellers both come into power, leaving a candle with wicks on either side with a small body called the doji. Usually in the center, when marking out the indecision candles, draw the zone from wick to wick. So this chart down here, I have identified the doji candle and I have drawn from wick to wick, and it's left the imbalance behind with that impulsive move to the upside. And now you just wait for it to come back to the zone, either enter aggressive or wait for that confirmation. But here's my consolidation period where those buyers have taken out those sellers. So essentially this zone is going to be highly reactive because it has taken out liquidity, created imbalance and high volume. So there are more ways to draw up zones. You don't have to just look for those doji candles. I would say it's the more traditional way, but there's definitely more ways to draw up a zone. So here are just some few examples. This candle over here, it's not exactly a doji, but it's still got that impulsive move that's engulfed that candle. That's another way of just drawing up a zone. Here's another way. It is a doji, but it hasn't engulfed this previous candle, which is still okay. Hopefully that it has high volume and maybe has taken out some sort of liquidity, but it has created imbalance. So that zone should be later on filled. Now this candle over here, it's been engulfed and created imbalance. So you can mark up the zone that way, or you could even just draw it from this body to this wick or this wick to wick, depending on the risk tolerance you have. So this is zone type 1, the wick to wick. I would say this is the most traditional way. This is also the way that I mark up my zones, because I've noticed you can still get a great risk to reward, and also you get the opportunity to get into more trades than the other types I'm going to go over. So type 2 is basically getting more aggressive with it. So you're marking it up from wick to body. So you do get a better risk to reward, but you do end up missing a lot more trades and you get a higher risk that comes with it. Same with the next one, it's body to body. I never mark up my zones this way either, because in my opinion, it's just way too risky. I like to go with a looser stop loss so I can feel comfortable entering trades and just letting it run. But with this, I've seen people mark up their zones this way, and that's fine, but I just don't do it this way. So now I'll go over some examples on the chart. So over here, This is the last down candle before the up move. That's created imbalance, and it's got high volume, so that's great. So the imbalance starts from this wick here, obviously, to this here, but it's been slightly filled, so the imbalance is here to here now. So price will come back and fill that in the future. So this candle here, it's not exactly a doji, but it still looks great because it's got somewhat high volume down here. Probably mark it up from probably this candle here. There we go. It's got a nice reaction, but later on the sell was off, so hopefully some profits may have been taken there and stop loss moved to break even. But for this example, it was a 1 to 3, which is great. You could have even just closed out the trade there, kept all the profits. This zone here, so market structure is bearish now, obviously because of this change of character that has happened. And you've got your doji candle here, the last up candle before the down move. It's got this imbalance that price had to come back and fill, and did it perfectly, and reacted pretty well. Also down here, you've got a nice demand zone, so you could have targeted this demand zone and traded it maybe, but most of the time I just like to take profits at zones. Don't get into the wrong side of the market, but you could have taken both these trades and had a pretty good risk to reward in the end. 1 to 4, 1 to 6. But yeah, that's basically what you look for. So that's basically about all I want to cover in this video. The next video I'll be going over imbalance, and I'll be a little bit more active on the chart, just because I feel like it's easier showing some examples on the chart than a presentation sort of slide. But I'll see you in that next video. Take it easy, guys.